to me, Aaron, you know how dangerous that is.
All right, in your hands, mate.
Great. All right. Well, welcome everybody. So I guess firstly, let's make sure that that I have control of the slides. Yep, great. So look, what are we talking about? Pretty much, we're going to talk a little bit of history, but we don't want to dwell too much because we obviously want to talk about the processes and that we've created and that can potentially help you with regards to these legacy pensions. But we do want to give you a history of the legacy pension elements, a review of the regulations and how and where they sit with regards to everything there, and then other considerations, because these, as great as these regulations are, and I can't think of a better lot of regulations that I've seen in my entire time in the superannuation industry. I mean, I might be stretching with that, but I think these are pretty special. We'll work through them, but they're not going to be all things to everybody, and I think it's important that people understand that, particularly with the legacy pensions. Yes, they're exciting. Do we act now? Well, we've got 5 years, so there's really an opportunity for people to think through what they're doing in that regard. And then similarly with reserves, we also appreciate that this is a fairly limited marketplace as well with regards to a number of funds that are dealing in this area.
So Tim, I think the reason why you said it's so significant is that you've just totally nerded out on this, given your expertise and experience. And I mean, I must admit, I'm very much the same. So when this come out, and I'm sure many people who are online at the moment are probably in the same had the same nerd alerts that we did when all this came out, and hopefully we'll try and unpack some of that for you today.
Yeah, well, look, and I think that's a little bit of the concept of narrowing the focus of what we're going to talk about today. And so, there's the technical side of it that, we want to talk a little bit about trust deeds, and I'll hand over to you, because that's when we're talking about nerd factors. It's one of your favorite domains there, Aaron, is to talk about things like the deeds, and then other impact issues. So social security, total super balance, transfer balance cap, estate planning. They're all the things that need to be considered amongst these decisions beyond the one singular concept of should we stop these, yes or no. It's then the flow on event of all the other things that go with it. But then when we talk about, why are we running this and what are we looking at doing that, that's when it becomes that kind of that nerd concept. And I was thinking a little bit about it in the process, and I've been thinking about it since these regs came out in September. But pretty much my first introduction to self-managed super or excluded super funds, as they were back in 1999, that was when I moved from the tax office to Cavendish. And pretty much the first person I met was Peter Crump. And I sat down with Crumpy in the offices at Cavendish, and he showed me through his calculator for these defined benefit pensions, where you had to, could have a lifetime pension that you would commute and then make a fixed term pension at age 65 and all sorts of stuff. And he said, and my calculator does all this, and it shows you that there's a reasonable probability of everything working. And it's like, what do you think of all that? And I said, well, there's a reasonable probability. I didn't understand a single thing you've just said to me. It then forced me to learn. And so I think for those of us that have been in the industry long enough, we were forced into that with these sorts of products. And that's why, to be a part of that treasury piece with the SMSF Association and a table and a room full of other SMSF legends in regards to their knowledge in this space was really, it was a bit of a proud moment in that regard. And so to use our expertise to then be able to produce documents to help people is ultimately why we're here and why we're wanting to provide this webinar for people today. So putting together the knowledge base of you and I have built up over that time frame, plus the stuff we've done working with other parties throughout that quarter of a century, gives us a bit of a guide. And so I wanted to just sort of hand over to you for these next couple, Aaron, just to sort of expand on that a little bit.
Yeah, because I think when we talk about what we do in the business, we've focused on SMSFs and SMSF only in documents, and this is what we tend to see in the marketplace with service providers more generally that we see. In particular across documents and so forth, is that there's certainly a breadth of documents and knowledge that happens, but then you go into extended, what I say is extended and strategic based thinking, so depth of content. And this is, to me, where someone like our business really, and there's others within our industry, very finite few, that have that specialization in the sector and the knowledge that comes with the years of experience in here. And I guess, thinking through what needs to happen with these clients does then become really important, looking at the depth of knowledge that actually needs to be taken away from something like this. So, we've spent a lot of time since these regulations have come out looking at the impact on the deed, but equally looking at the impact around what it means for those pensions that now have the ability to commute as well. So I just thought this is something that we have included in a number of other sessions recently, and just talking with Tim about how we are different in the marketplace, and a lot of that ultimately comes back to the fact that we know what we're good at, and we're really good at our SMSF based stuff, and this topic is a perfect example of where that depth of knowledge and specialization really does come to the fore. So as we kick things off today, what I would be interested in trying to, I guess, find out for the benefit of not only us, but also for everyone online today is just to ask the question, which of the following here in terms of pensions and or reserves do you have with SMSF clients? So Tim, the Treasury indicated there were some 16,900. My guess, and it's a fairly reasonable guess now, we've done a bit of homework around this, probably half of that would be within SMSFs. So I suspect there'll be a fair bit in retail land. We did see at some point some of the retail products allow for, basically rollovers of market-linked pensions into a retail product whilst they're around as well. So just wanted to kind of find out from people how many of these things are floating around, and what you have been impacted, or what clients are impacted in what sort of areas. So we'll leave this on for another 5 or so seconds. So is it only market linked? Is it a bit of market linked and defined benefit? Are you looking at it from a reserves perspective? Away we go. So I'm going to end the poll in 3, 2, 1. And what we can see here, Tim, is that about a third are in market-linked pensions. We've got almost another third in sort of a combination of market-linked and complying. So it's fairly even spread. And there's some there that are just simply for reserves as well. But it just gives you an indication that for those that have been around long enough in funds that have been from the late 90s into the creation of SMSFs, and then in the early 2000s, there are still plenty of these floating around that keep us on our toes, is probably the best way to refer to it as.
Yeah, and look, and I think we sort of recognise, Aaron, from a processing point of view, that that the numbers would suggest that for every one lifetime pension, there's probably at least 10 market-linked pensions in that regard, and I was quite intrigued with the number there of people with flexi pensions as well, because they are a very unique product, and they number the tens rather than the hundreds in regards to the SMSF space. So it's good to see some people involved from that as well. So I wanted to just run, and I'm not going to go through this timeline, in too much graphical detail with regards to these pensions, but it's really just to highlight that we've seen some key issues, and probably the biggest key issue for the decision-making process, and we will harp on this a little bit today, so to be mindful of that, is in 98 we saw the asset test exemption issues or associated considerations of Social Security expand to lifetime and life expectancy pensions. So that was quite a significant issue, and at the same time we saw the introduction of these lifetime pensions from a CIS point of view. So they were introduced as a pension, and they were measurable against the RBLs. Now, most of the stuff that we're talking about today is linked to 2 intrinsic issues: pension reasonable benefit limit and asset test exemption. So the 2 extremities of the superannuation industry: I've got too much money, or I have a certain amount of money and I'd like to hide that money for legal Social Security reasons. and asset test exemption of where that applies. So they were the key early things. We then saw a lot of sort of administrative changes over that early 2000 period, which culminated in 2004, 20th September 2004, which was the introduction of market-linked pensions. So, the concept that self-managed super funds didn't have the capacity, or really didn't have the capacity or the asset backing to be able to guarantee income for life was clearly a concern. And so we saw some regulatory change there, which ultimately meant if you weren't in these things, and if you weren't a member of a self-managed super fund on the 11th of May 2004, you were never having a lifetime or a fixed term pension within that product. You still had another effectively 18 months to be able to set one up. But if you weren't in on that date, you were never going to have one, and you're only ever going to operate in the account-based pension world of, back then, market-linked pensions and allocated pensions. We then obviously saw super reform. Aaron and I struggled with typing either better or simpler with regards to the 2007 super reform there.
Well, as we said, there was nothing ever simple about it, was it? So
that's right. But importantly, that saw the abolishment of RBLs, which sort of then meant that these market-linked pensions, which were pretty new in the industry, were often considered redundant within, again, 18 months of being first introduced. But a lot were established in that time frame. And hindsight's a wonderful thing, because with that RBL abolishment, many people probably wouldn't have jumped into the market-linked pensions as such, or indeed the other pensions. And so then we saw a number of other changes. The most significant for me, one is the ATO's communication in 2015, which I think has dictated a lot of how we operate in this space with regards to allocations from lifetime pensions to commence market-linked pensions. Fairly significant consideration there. And then super reform of 2017, which introduced us to the concept of a cap defined benefit income stream. So we've seen a lot of sort of targets along the way, a lot of milestones, and pretty much since that July 2007 timeframe, there's been a cohort of this industry who have been saying we need to have the opportunity to get rid of these pensions. So look, it's only taken 17 years. So that might be considered short in the scheme of many things, but 17 years later, and we've got these regulations. And for those who have been waiting for them, now is the time to at least look at what it means with regards to your clients. And so, Aaron, I'm just going to hand over to you again to talk about the deed.
Yeah, so the follow-up, I guess, to that is then just seeing how the construct of these rules or the powers to pay pensions have also sort of changed throughout that time. So again, without sort of jumping into each of these specifically, it's noting that prior to 99, we had a fairly generic set of purposes within the deed that dealt with the old allocated pensions. And we're pretty much back to that type of scenario today, where the rules are broad enough to allow for a pension in accordance with the regulations. But what we did see in the early 2000s, which is when a lot of these pensions were set up, is that we needed to see specific clauses or rules added into deeds. And on the right-hand side is just an example of one of the deeds that we saw at that time that needed to put in very prescriptive information that allowed for things like asset test exemption. So many of these deeds that are in play, or the rules of these deeds that are in play for these types of pensions, are in essence not providing for the commutation of what is a non-commutable income stream. So these new regs will ultimately need to contemplate what the governing rules of the fund say, and noting that over some period of time we've had deed updates, but the rules that related to those pensions should have flowed through as part of that deed of variation approach. So again, just to show you, I guess, what has changed over time, and importantly, the fact that there will need to be some type of adjustment to allow for this commutation of what is a non-commutable pension.
So, as I sort of alluded to before, we're really looking at two classes of clients. There's a third class, which is those that just wanted a steady income stream, which you didn't get under an allocated pension back in the early 2000s. So allocated pensions had your minimum, maximum factors applicable to them. What you got with these pensions, with these defined benefit pensions was certainty around income subject to investment performance, in the sense that when the markets crashed, these pensions found themselves in a lot of trouble, particularly under an asset test exempt scenario. But really they were set up for either pension reasonable benefit limits, which was the higher balance that you could hold in superannuation to be able to receive tax concessions on the benefits that you received. And so some of you may remember terms like allocated pensions or non-rebatable allocated pensions. Well, a non-rebatable allocated pension was when somebody went over and above their lump sum RBL limit. So by starting a complying pension, which lifetime, fixed term and market link pensions were, by starting those compliant pensions, you got to measure against the higher reasonable benefit limit, which ended up in 2004, and I use 2004 as the peak time there, at about 1.176 million. People had higher reasonable benefit limits, but that was the standard one. And you had to put at least 50% of your benefits into those pensions to be able to comply. So that was one of the reasons. The other one, which was very significant, and particularly a lot of the pensions, if you go back over the history, you'll see a lot of pensions started immediately prior to the 20th September 2004. So September 2004 was probably the busiest compliant pension commencement month, because if your pension commenced in that period, it was 100% asset test exempt, which meant for a lot of people that they could shelter a lot of their superannuation benefits from the asset test and avail themselves to full social security. Now that's come with its challenges along multiple market crashes and requirements to satisfy solvency along the journey. But any of you will know, if you've got clients that have asset test exemption, it is one of the only reasons why they still have self-managed superannuation funds, is because of the social security benefits that they have received along the way. And so one of the things that we will talk about is the impact on commuting these pensions on asset test exemption. So certainly an issue to be mindful of there. Now, if I move forward, and Aaron, I think you might need to give me back the access there, great. So let's have a look at the regulations. So let's get into the nitty gritty of how this works and the processes that we've actually built here at Smarter for us to highlight for you. So we got these regulations. They were lodged. We had our consultation period. I said that was a really positive experience. As much as we would have liked to ask for some more things, and did ask for some more things, we certainly can't complain with what we've got, because they provide exit strategies for pretty much everybody in some way, shape or form, and we'll work through all of those exit strategies. They're in effect from the 7th of December, and I'll talk about the effectiveness of them in a moment, and the potential for the regulations to be challenged. But what they provide for is, in very simple terms, is they've introduced some changes to the SIS regulations that state that these three pensions, lifetime complying, life expectancy and market link pensions, under those three regulations 106(2), 7 and 8, are all non-commutable pensions. These regulations simply insert clauses to those three sections to say that they are commutable, in accordance with a new section, which is a 106C section, and that is effectively the commutation amnesty, which says you have a 5-year period to be able to commute these pensions. And that ultimately is all that these regulations provide for. And that is that if you've got one of these, you can now stop it, but there is a sunset clause, and that is in 5 years' time. After that, if you've got it until the end of time, and so the end of its time as such. So there's no need to act right now, but it is certainly something that people will look to act on. The other key thing, so 5 years is a key issue. The other thing is that it is a full commutation, right? So it is not about, I wouldn't mind partially or taking some of it out to access some capital. It's all or nothing approach. So you either stop the pension or you don't stop the pension, right? From there, what you do with that money is ultimately, or what your clients do with that money is totally up to them. They can, subject to the transfer balance cap, potentially commence account-based pensions. They can leave that money in accumulation, or they can take that money out of the superannuation system. So it's ultimately a personal decision as to what the clients want to do. One thing to highlight though is if they are in receipt of a reversionary pension, then those restrictions change, because it's already met that death cashing restriction. And so we know that death benefits can't be rolled back to accumulation. So if you're commuting a reversionary pension, then there's only one option, and that is that that ultimately the money is coming out of the system. I mean, you can look about death benefit income streams if you want to, but for most people, they're going to stop those to take the money out of the superannuation system to not further expose the fund to future estate planning. One of the things that we'll highlight a couple of times is that by undertaking this, you may create other issues, right? And so you might have some tax considerations, particularly based around the cap defined benefit income stream issue there, where those pensions are currently sort of excluded as such from the transfer balance cap, but they have the capped income amount where they are taxed at marginal rate on 50% of the income above that threshold there. So you've got tax considerations, right, to come into all this, but there is no tax on the commutation itself. And I highlight that because when this measure was first announced in 2021-22, it was that they wouldn't count towards the caps, but there was going to be a 15% tax. That was the original announcement. So the point here is that on commutation, there is no tax impost, but that doesn't mean that there won't be any tax impost on the clients who undertake these. From a regulation point of view, really simple. These regulations were registered, or they were lodged on the 6th of December, which meant they were registered and came into effect on the 7th of December. And they are in force from that date, right? They needed to be tabled in Parliament. They were tabled in Parliament yesterday. There is now 15 sitting days from them being tabled where a motion can be put to disallow these regulations, right? Now that 15 sitting days gets pretty complex because we're all about to go into election mode at some point in time. So that 15 days will pause if an election is called and will restart when Parliament resits. So if we don't get to, say, the 13th of May, and let's be honest, most of us think we won't get to the 13th of May, then there is still a possibility in a new Parliament that these regulations will still be open for removal. But the positive thing is you can go your hardest until such time as they are removed. So that's just a key thing to be mindful of, that they're in effect from day one. From a compliance point of view, there's some other key things that we need to be mindful of. So, yay, we've got these regulations that say these pensions are commutable. Yes, we're going to look at such things as the deed and those sorts of considerations, but you've also got to look further into the CIS Act, because to comply with the various sections, you then have to comply with further sections of the legislation. And so from a regulatory point of view, you've still got your minimum pension obligations to consider. So you've got your pro rata considerations for market link pensions, but you also have your pro rata for your lifetime. I'm going to speak mainly about lifetime, very little about fixed term, because there's probably, when we talk about a handful of fixed term, I mean, that would most likely be, two hands full in total of fixed term. And there's not going to be a lot of them still around, but I do know that they exist. But you've got to meet this pro rata requirement. And there's two key differences here. Account-based pensions, like a market link pension, they have a financial year minimum pension obligation. So you calculate your pro rata from the 1st of July to the day of commutation. For your defined benefit pensions, you operate under a payment year concept, right? And a payment year concept is based on anniversary date of commencement, right? So when did you commence versus when did you commute? So that's going to be different for every fund. For a lot of funds, maybe it's 20th or 19th of September 2004, whatever that date is, that's when you've got to do your pro rata calculation for. So just something to be mindful of, that this isn't just a stop and you're done process. It's a, have you ensured that you've met all your obligations in the current year, then you can stop, then you can do it. So it's almost a prospective date. I wish to commute on the following date, then you can do your calculation up to that date, ensure they draw their income, and bang, stop the pension at that point in time. That's the way I'd seen it look at it. I'm not sure about yourself, Aaron, but I think that's the way.
Yep. No, absolutely.
Let's quickly talk about this asset test exemption, because I think the key thing here is that we've all seen what the minister has announced, and we've all seen what was in the previous budget announcement back under the former government, and that is that once you commute these pensions, they will lose their asset test exemption. Now, there's a further debate as to whether the change in the regulations means that all of these pensions lose their asset test exemption. That's a conversation that I think we'll have to see sort of play out with regards to Social Security. But more specifically for those that stop their pension, they will lose their asset test exemption. So the fear is that when you stop your asset test exempt pension, then Social Security have a clawback capacity where they can go back and reassess you over the previous 5 years, right? Now, without a waiver of debt, so they can raise a debt over that 5-year period if the assets that are now counted would have put you into a territory where you've been paid too much from an age pension point of view. So we need a waiver before anyone can contemplate stopping an asset test exempt pension to give peace of mind to those clients that there'll be no debt raised. The government have indicated it's happening. You know, I've been watching every day, as I'm sure many have, the legislative instrument email that comes out to see whether something's come out. Nothing to this date. It's not an exciting email, trust me, but we haven't seen anything to date. However, there is a waiver in place where if you roll one of these pensions to a market-linked pension, then it will be 100% asset tested, but there'll be no debt, or there'll be a waiver of any debt. And the reason I point that out is because some people's biggest concern with these defined benefit pensions is that they are, in essence, a reserve, and so the money doesn't belong to anybody. So if you've got somebody who is of ill health with one of these pensions and they don't want to have to deal with reserve allocations of a deceased member, then potentially there is a capacity to commute to a market-linked pension for the ability to then subsequently commute that again. That's a double process, but it is a one way of looking at the asset test exemption. So certainly an area for people to be mindful of there. So what we then kind of look at with this sort of scenario is, okay, well, what are we actually asking? What are we asking the clients? What are you asking your clients with regards to these pensions? So does the deed, you know, as we've already talked about a few times there, does the deed allow for it to be commuted? Or do we need to make a change to that process? What type of pension does the client have? You know, do they have a market-linked pension? Do they have complying lifetime? Do they have complying life expectancy pensions? Is that pension subject to asset test exemption? Because, as I said, that's going to be a red flag straight away. Is the pension being paid to the primary or the reversionary beneficiary? Already highlighted, that matters. You know, it matters in the instruction that we can then give to the trustees of the fund with what to do upon the commutation. And then for those market-linked pensions, was it commenced post the 1st of July 2017? Right. So we know that these legacy requirements, these regulations, are in place for pensions that were commenced prior to basically the 20th of September 2007. But we know that we have been able to commute and then commence market-linked pensions since that time, so it also applies to those. But what's important is, from a market-linked pension point of view, is it a cap defined benefit income stream, or is it an account-based pension for our transfer balance account reporting? And we'll highlight what that looks like, because we want to work through with you a bit of an example as to how we would go about commuting a market-linked pension.
Yeah, so Tim, just before you sort of keep going there, I think what's most important, and we might, if you can go back to that slide, I think the reality is, and many individuals that sort of our peers ultimately in the industry, since these regs have come out, it's then enabled us to try and distill down, and we have in essence distilled down the impact of these into sort of half a dozen bullet points. So I think that's the most important, that there is now I guess a defined process around the things that you need to be considering here. And I know it took us a long time to work through this and talking to people, but when you unpack it all and you bring it back to these questions, it is actually a relatively straightforward process then, in terms of the advice, document preparation and stuff that you know, you need to consider. And then once you've sort of moved through that, it's then, well, what do we need to look at on the other side once the decision and execution of that decision has been made. So are we starting a pension with it? What do we already have against our transfer balance cap? Are we taking it out of super? Are we leaving it in accumulation? Can we leave it in accumulation? All those things. But ultimately, we have this kind of predefined path here that allows us to exit these sort of income streams.
That's right. That's right. And in saying that, we're not underselling the tax considerations and all the other sorts of things. They are 100% top of mind. We're just basically going, well, you know what? At the end of the day, the concept of commutation drills down to a couple of things. The decision to commute is a different piece, and that's the piece where you need to add all of the other sort of substance to it.
And consistent with what the commissioners had around what a valid commutation is in TR 2013-5 as well.
Yeah, well, let's not hijack this one with our opinions on TR on that ruling. So let's look at these regulations in relation to a market-linked pension, because, as I said, when the construct is that, you know, and through that work that we've been doing, sort of in the preceding 3 months since the regs sort of came out, it's longer than that now, is we've highlighted that from a defined benefit pension, yes, you've got all these other issues associated with reserves or whatever, but there's more parameters linked around market-linked pensions, and obviously there's more market-linked pensions, and so, you know, we've certainly spent a great deal of time focusing on these with regards to the various outcomes that people need to achieve. And I guess one of the things here that I want to highlight, and in this example here, we've got Dennis, who's getting his market-linked pension. And he has his value as at the 30th of June 2024 of 1.215 million. So before I go on with that, is we are looking at clients that are largely, there will be the odd exception, but largely 80 plus, right? So we are certainly talking about those that are in the final years of their SMSF membership, and some of them are only in their SMSF membership because they've still got these pensions. And so, you know, there's a lot of other sort of add-on issues to contemplate there. 25.76% tax-free. The tax-free percentage, and that's obviously important when we're doing any sort of commutations to know what the outcome is going to be at the other end. It's not anything to do with age pension, and there's been no changes since the introduction of the transfer balance cap on 1 July 2017. He draws his pension annually, and he's been advised of the new regulations and wants to look at what his options are with regards to restructuring. So let's then touch on this, and I'll jump over again to you, Aaron, just to run through the first thing we want to do, which is have a look at the deed.
Yeah, so ultimately, we all know as specialists online, many of us, I'm presuming, is, you know, where do we go to first? We go to understanding what the regulations and ultimately the rules of our fund would say. So I highlighted earlier, the reality is that we will have very prescriptive terms. So we need to be going back and looking at the documents that establish these pensions, which may not exist, may be very flimsy at best if we go back to that sort of point in time, and understand what the rule or clauses were that provided for that pension at that point in time. And I highlighted earlier that in many instances, there's been multiple deed upgrades since that point. But in essence, those specific provisions around the ability to pay that market-linked pension or that lifetime pension or whatever, will, in essence, that hard wiring will have followed through in each of those subsequent deeds by virtue of the variation clause that should have been included. So we need to look at those specific rules. We've made a number of changes within our Smarter SMSF deed. There's a change log in respect to those for our members that want to have a look at and understand how we're reframing that at the moment. And then if for any reason there is a situation whereby you've got more broader pension terms rather than more prescriptive terms, then arguably you may not need to look at the deed, but you're going to have to look at the pension contract, and ultimately between the member and the trustee, agree to make some sort of change to the terms and conditions of that pension contract. I see that as being a more unlikely scenario because of the prescriptive nature of many of these, in particular for asset test exempt purposes. But you really have two approaches that you'll need to look at. One is through the deed itself and updating the rules to allow for an import, in essence, the ability under these regulations to allow for that commutation. Or two, if there is no deed upgrade in respect to that, or you believe it's broad enough in its powers, then you'd want to be seeing some sort of change around the terms and conditions of the existing income stream documents within Smarter SMSF. We could do that by way of becoming a special rule of the fund, and then in essence, the trustee member making that specific change themselves, like we do when you may add or remove a reversionary. But again, just understand that kind of first step that you need to do to ensure that the change that you are making is actually allowed to be done.
Cool. All right. Well,
yep.
So we've looked at the deed. We then need to work out what have we got. So have we got a cap defined benefit income stream, which is our pre-1 July ones, or an account-based pension for our post-1 July commencements, which of course is going to have a difference from a debit point of view. For those that with the cap defined benefit income stream, because we've now got the commutability around market-linked pensions since April 2022. So now if you started a new pension after 1 July, you would have had an excess transfer balance cap determination to be able to commute that, and it'd be lined back to your transfer balance account. But for your cap defined benefit income streams, you now operate in the world where you've got the defined benefit income cap. And that cap is indexed in line with the transfer balance cap, so it should go up to $125,000 from the 1st of July this year with indexation of the cap, and anything above that you're paying marginal tax on 50% of anything you paid there. So there's a tax consideration with regards to these pensions that of course you could be alleviating by putting your money into different vehicles under the transfer balance cap, but you may also be restricting your ability of how much you can put in based on the calculations you have to perform. So what we know here is that we've got a transfer balance account for Dennis of 1.829 million, which was his special value from his original pension that he started, and that was in place on the 1st of July. His total payments from the 1st of July 2017 until the 30th of June was 507,589. You're going to need that information, right? So if you've got a CDBIS pension, now you can obviously extract that information from your software, but you're going to need that to be able to do the calculations. But you also need, obviously, your balance at the start of the year from a minimum pension calculation. So what we want to show you here is that the calculation for the T-bar debit for market-linked pensions that are these CDBIS pensions are quite, it's complex in the sense that it's not your account value, right? It is effectively the initial transfer balance credit less any other transfer balance debits that have arisen in respect to that pension, right? Less the total super income stream benefits that you've received before the start of the current financial year, and then less the greater of how much you've paid this year and the minimum amount required to be paid under the regulation. So there's a fair bit to that. And, again, this is where we've provided you with we can provide you with assistance with regards to this. And Aaron, what I'm going to get you to do is I'm going to get you to share our calculator so we can show you. We've done that. We didn't want you to have to watch the painful exercise of me trying to fill in numbers on a calculator. So we have pre-filled them there. But we have, and this again is available through our forms with the ability to do it, our commutation and transfer balance cap calculator. So what it does is you effectively provide all the information you need with regards to the member, the term remaining, the balance at the start of the year. Now, the balance at the start of the year is going to give you your pro rata minimum requirement for the year. So it'll show you your minimum, maximum, show you what your pro rata is. So you can plug in your date and say, I want to commute on X day. All right, Dennis has gone with the 31st of December. So we plug that in. He needed to take 61249. He's taken 61250. Right, we then go, now, if our commencement date is after 1 July 2017, the bottom of this calculator ultimately disappears because the account value is the debit is the account value. But otherwise, we put in our initial credit that was in the transfer balance account, and then our annual income each year. And it gives us our transfer balance cap debit that needs to be reported from a market-linked pension point of view. So we've got all the information we need from a reporting point within that calculator, but also all the key information we need to be able to then go back and generate the documents to be able to put in the process of commuting that pension. So we go from there and we end up in a situation where we work out what our value is. It's that 1.26 amount that becomes our debit. That then brings our transfer balance down to 567,000. We know that our personal transfer balance cap is 1.6 from that first year. So it avails us the ability to put just over $1 million in an account-based pension, but we're going to have $194,000 that either remains in accumulation or comes out of the superannuation system. We can't put that back in. So unlike an account-based pension where it's a like-for-like swap, you're going to have the issue of not all that money is going to be able to put back in, and that's something that you have to work through with from the process. So
yeah, and Tim, I was just going to say that's where if there has been some change post 1 July,
yep.
well, then the reality is that calculation is different because it does look like from that point in time an account-based calculation as opposed to a calculation that has been accruing the pension obligation in each year since basically 1 July 2017, as we showed in the calculation.
So again, that's sort of where we provide the first piece of support there. And then if I think you need to give me control back there again, we then go and create the documents, right? So this is where we effectively give power to you as to how you want to do it. But ultimately, for those that want to use our online version, they've got the confidence and the capacity to enter all the material themselves. Then you can literally use our online platform. If you're with Class, BGL, Supermate, you can import the necessary data. So again, having the funds processed up to date will allow you to import all the fund details, your tax-free taxable percentages, your balances, all that sort of stuff that you're going to need from the documents that produce. You can drag that in through our integration with those platforms. But we also have a manual process where you can fill in an Excel form and go through that process. So you put all the information in through the form, and then you generate the documents. Aaron, I think you're just going to throw up the documents onto the screen.
Yep, I am. Just give me 1 second whilst I get all that ready to go. Too many screens open. Where are we here? Okay, so what we've got in our system here, and I'll do one that I'll go to here first. So in our document platform, there is the ability to now access within here, and you'll be able to see it, our MLP commutation, and it naturally goes through and explains the information that's provided and the detail in respect to that. So there is a specific form. Naturally, Tim and I have done we've prepared one earlier for you, but I will just show you very quickly from the saved order that we are capturing in here details about the fund, about the relevant member, all the details that we need ultimately to enable us to generate the template automatically. You can see in here, as Tim iterated before, the fact that we have the integrations that are available. And then, like we discussed in the slides earlier, we then have specific information that we're asking as part of that particular process to enable us to, in essence, then get the outcome that we need. So is it a primary or reversionary, and why that information is different? So we've got different tooltips in there to do, and then from within the form, you can actually access that as well. The other thing then is once that has been completed, it will generate the relevant documents for you, again, based upon all the different variables that we have throughout that process. So for those of you that use already our account-based pension documents, our death benefit income stream documents and so forth, the process is in essence exactly the same. In terms of the fact that we have our requests and our resolutions and then our notifications and any other supporting documentation that come with it. So we've really distilled down this process not only as we articulated before, but for the benefit or for the purposes of us building out these documents in the first instance as well. As I said earlier, we see the importance of going back to the deed as well. So you will be able to look at doing deed amendments in here as part of that process if you needed to. And where relevant, we have legal review for you to obtain in respect to all those sort of parts to what is the jigsaw of a legacy pension being commuted. Tim did mention as well that we have a manual form. So again, we've just used an Excel-based form in here, simply again to go through and ask those questions as well. Again, we do have it for a defined benefit pension. So we've tried to ensure that we've got a pathway for everyone who needs that support. Either you're competent enough to be able to prepare that documentation yourself, or if you're not, then you can enable us to go through and do that, and the ability to not only look at the commutation of the MLP or DVP, but look at potentially the requirements under the deed as well.
Excellent. All right, so let's, being conscious of time, let's move on so we can look at these defined benefit pensions and reserves, because as I said, we think there's a little bit more to it in regards to, say, the end product piece with the market link pensions comparative to the DB pensions. But certainly one thing to be mindful of, Aaron, I'll get you to jump to this one. Perfect. We're talking about 106.2 and 106.7 pensions. So right, it's lifetime and life expectancy, but we're primarily talking about our lifetime pensions here. These regulations don't apply to our flexi pensions, our 106.6 pensions, right? They're not captured because they're already commutable. There are already rules in place for us to be able to commute those pensions. So what we then need to consider is what else beyond thinking about asset test exemption do we need to consider with regards to the commutability of this. One, do you need to get any actuarial guidance, right? And to me, that's a clear question, right? Because we're dealing with reserves, right? We're not actually dealing market link pensions, we're dealing with account balances, right? Compliant pensions, we're actually dealing with reserves. And I'm going to jump into the softwares and show you some of the differences in a moment. But conceptually, it's all a reserve. So therefore, actuarial support is needed to be able to determine, right, particularly with multi-member funds, how you do allocations of those reserves across the members, so the commutable values and all those sorts of things. So it's going to be important to know what software you're using, because the different softwares report things slightly differently, right? And they all allow for user flexibility. And so there's how most of the softwares report, and there's how people might have tried to do their own reporting as well, which will create all sorts of nuances. But understanding a simple concept of whatever you've created for these pensions all merges into one reserve is ultimately where you're going to get to. So software is going to play a big part in the advice process for both actuarial and financial advice for those seeking financial advice there. So how are your pensions recorded? What have you got? Have you got active lifetime pensions? Have you got inactive lifetime pensions because the members died? Have you got a term pension? Have you got a term pension that's ceased, right? Or have you got flexi pensions, and how are they all recorded? So it's going to be important for the commutation piece, but also then from the reserve allocation. But if we look at this from a simple piece and address sort of the ability for a client to commute, let's move on to the next example there. And where's my little arrow? There it is. Perfect. Oh, okay, before I move on to that, I said I'd bring up the system. So this screen is a representation of the three software providers that have the majority of these funds active within their systems. So you've got Supermate on the left there, BGO in the middle, and Class on the right hand side. The big thing here, the primary difference is, in most practical senses, Class and BGL still record the pensions under the member statement, right? So the full amount inclusive of the reserve is going to be incorporated into those member statements. There will be variables of that. People will have tried to create reserves for the amount over and above best estimates and other things like that, but you'll find in the majority of scenarios that the amounts are still recorded under the individual member's balance, right? But recognise that from an ATO point of view, under ATID 2015-22, that the account balance together with any reserve represents a reserve, right? So multiple members, one reserve to support the payment of these income streams. Supermate have taken that approach. You can see that there with the bottom highlighted piece, which is directly from the financial statements, the statement of financial position, where you've got the amounts allocated to members, so that represents their account-based pensions, and then you've got the not yet allocated amount. That not yet allocated amount each year gets allocated to the members' interest, which starts at zero, to pay out the pension and then ends at zero. So it's pretty much the member account is a funnel to make that allocation from the reserve. So that's Supermate process versus the BGL and class process, where they operate and will show on the financial statements the member balances, but that's recognising it's an account-based pension. So that's pretty critical, I will say very quickly, in the sense of when you're giving advice in this area, that people understand that what that statement says is not necessarily what their account balance is, right? Because it's an amount that represents a reserve. Now, if it's a single member fund, yes, it's going to be that amount because that represents the entirety of the reserve. But where you've got multiple member funds, the numbers may vary slightly in that regard. So it's just something to be mindful of there. If we then look at the example of our client in this regard, we will see that, and I'll just get you to jump, Aaron, I'm not sure what's happening with my controls here. So Robert is 87, got a lifetime pension and currently valued at $1.1 million, no longer thinks it suits his needs and he wants to access his super capital as required. So he commutes the amount, including the reserve, back into accumulation, and he gets a debit in his transfer equal to the original credit, which is 1.75 million, which then gives him enough space to commence his account-based pension. So the lifetime pensions are pretty simple in that regard, certainly from a transfer balance cap point of view. If we then move ahead, again, we'll see that the difference here from Robert's point of view, if he was a single member and he just had his $1.1 million, then he'd be able to just make that allocation. But if Robert's in the fund with his wife, then we're going to need that actuarial calculation to determine what is the full commutable value for each of the members. So that's how it's going to work from compliant pensions. And then similarly, you would go through and do the same documentation process that you do for market-linked pensions. Similarly with the fixed term. I want to finish by talking about our reserves and how reserves work from an allocation point of view. So these reserves also came in from the 7th of December 2024, and there's a couple of things that we need to be mindful of. In most aspects, all they do is replace the existing regulations that applied to make allocations from reserves that previously counted towards the concessional cap. They replace those with the reserves counting towards the non-concessional contribution cap. So that provides a greater scope for the amount that gets allocated, and we'll touch on that in a moment. However, there's effectively an extension of the reserves to say there's an exclusion to the contribution cap, so either concessional previously or non-concessional now, where the reserve was solely supporting an income stream, right? And that income stream has been commuted or has ceased, which includes where it ceased previously. So a fixed term pension that might have finished 5-6 years ago, that reserve is still considered under these regulations a income stream reserve, right? Then allocations can be made from those reserves and not count towards any cap, right? So that's a huge win for all of those existing fixed term pensions where the member is still alive, and it's critical that the member or the last recipient is still alive, but it's also huge for our flexi pensions, because what it actually means is that we can commute a flexi pension, but then the commutation value is rather small, and the rest goes into a reserve. We can then make an allocation out of that reserve back to the member, and I'll go through an example there. You've then got your fair and reasonable, so any allocation up to 5%, right, or less than 5% as the amount won't count towards any cap. But this is where it expands to our self-insurance reserve, our anti-detriment reserves, whatever other reserves might apply. So if we jump ahead and look at a couple of examples, so we can work through this, the flexi pension. I call it a flexi compliant pension because it goes through many names. Flexi compliant. It's basically didn't comply with the RBL rules, right? It was measured against the lump sum RBLs. I won't go through a history of how they existed, but these effectively were already commutable. So Michael is 85 and he's got his pension in accordance with 1066, right? He's got a reserve supporting that of $2 million. So the very few of these that exist still, you are talking about significant money, right? So there's quite a lot of money still sitting in these 1066 pensions. But for whatever reason, he set up his pension as $75,000 with nil indexation, right? And there were restrictions on indexation around it. From a commutable value point of view, you have to commute them in accordance with the Schedule 1B factors that are found within the SIS regulations. And so the appropriate factor for Michael is 6. We times that by 75,000 means the commutable value is $450,000, which basically means that that amount gets rolled back into Michael's accumulation and gets split according to the tax-free and taxable percentage of that pension. The balance is a reserve. But under the reserve allocation regulations, that full 1550 amount can be allocated to Robert and not be captured under any cap. However, the entire amount is a taxable component, right? So the reserve allocation is taxable. So this is a huge result for these pensions for the few that are remaining. To quickly look at it, to show you from a fixed term pension scenario, you had a situation where Stanley passed away. He had an 18-year fixed term pension, which reverted to his wife, Shirley, when he died, right? At that point in time, the pension then ceased in 2022. So it's just been sitting in the account now. Shirley can allocate that and it doesn't count towards the cap. Now, of course, if it didn't revert to Shirley, then that would be a pension or reserve that's related to someone who is deceased, and that would then count towards the non-concessional cap. So if we just then show the last example, which is around reserve allocations, and we talk about someone that had a self-insurance reserve, and the reserve is now valued at $600,000. We've got two members in the fund, Jan and David. They've got $1.5 million each, and they've been making 4% allocations each year to keep themselves excluded from the concessional contribution cap. In this year, what they can now look at doing is they can continue to make small allocations if they so chose, representing that 5% amount, or they could say, well, you know what, this is now measured against our non-concessional cap. We haven't triggered our bring forward provisions. We're under the bring forward amount from a contribution point of view. So we could actually allocate $300,000 each and clean out that reserve in one go. And so this is where this measure is significant, as it gives us that capacity to make these large allocations. But by measuring it against the non-concessional versus concessional, it has the added bonus, and that is that excess non-concessional contributions can then be refunded from the superannuation system, and the only tax arbitrage is the associated earnings being taxed at marginal rate. So it does give us a capacity to look to make allocations, even with those with more or greater than their transfer balance, total super balance greater than the transfer balance cap, to be able to allocate and remove money from a reserve in the superannuation fund. So Aaron, I think that's going to bring us to summary. Well, I know.
So the one, I guess the last thing, just to, summarize in terms of what we're doing, and hopefully we've kind of highlighted this for you today, is that we naturally have the ability to undertake and assist around changes that would be required to allow for the commutation of pension. So again, whether you do some of that yourself, whether you want some type of support around that, to be reviewing the deed, reviewing the documents that may be in place. And there's a couple of questions that we'll come back to that may then assist in that particular process. And then from there, as we've highlighted today, the largest component of this legacy pension framework is really within market-linked pensions. So we've now done a huge amount of work to have that online form pretty much ready. integrations built with all three of our software integration providers there. You do have the ability to utilize that either through a subscription, if you are currently a subscription holder or want to look at that as a subscription, or you'll be able to order that on a pay-as-you-go basis. Equally, we will be putting up online the ability to use the Excel-based forms for manual request, which will include the bundling of that if you want to look at deed upgrades and so forth as well. We also have that defined benefit form. We're unlikely to build an online form just simply based upon the number of pensions in the marketplace. That just doesn't warrant us spending the time building out the same level of tech stack that we have for that MLP. But again, we may sort of look to that subject to how many flow through. Again, you can sort of bundle those things, but equally we do have all of these templates available, because for some time we have been doing work around DVPs to MLPs or MLPs to MLPs, all those sorts of things. So if you do have a number of these, we are happy to contemplate making those available to purchase under license for some form of unlimited use as well. And the final bit that we're doing is we do have a form around reserve allocations, but we are working through that at the moment. And we'll be advising people once that is finalised that you'll be able to use that, and equally we'll then put in the request form if you're needing to any specific documentation around those reserve allocations as well. So a lot of work's been going on in that December-January period to make sure we were ready, because I know a lot of these clients have been waiting for a long period of time to be able to do this. And I think, Tim, my view is yes, we have a 5-year period, but I think there will be a large cohort of early adopters to this. There will be others that, yes, they will consider hanging around for the 5 years. And there may be an even smaller group that may decide to not do anything. But the fact that you can exit something, and we've got much older clients, yes, there's tax considerations and Centrelink considerations and all those sorts of things, but these are the things that we should be proactively going back to these clients and having conversations with them, almost right away.
Yeah, look, and I agree with that, and certainly one of the things I'd say is, we have been active in this place. We've already assisted people with these commutations, and we've been doing work with commuting 1066 pensions and as well. So whilst we're still building the form side of things, we've got the documentations, which is adaptable to the client's circumstances. But I just want to reiterate a couple of those points so we can then finish up and look at those questions. Is there are going to be circumstances for things related to transfer balance account, obviously with personal tax liabilities, all these sorts of other issues that people are needing to be mindful of. And so we do reiterate that it is appropriate to, if your clients are seeking the advice and you're not able to give that, to get the appropriate advice that the clients need to understand the ramifications, particularly around things such as Social Security. So we can help most definitely with the numbers and everything, but we can't tell a client that they should or shouldn't do this. But I think a lot of these 80-year-olds, they know what they want to do anyhow. That's something that's pretty key there. So yeah, look, I really appreciate everyone joining us today. We were really happy to get so many people. We almost, at one point in time, almost had more people than there were compliant pensions, I think, Aaron. So
yeah,
we had some good numbers, and that was really appreciated. And we'll keep working to provide people with the support they need.
Yeah, absolutely. So we, as always, as we wrap up, we've got a number of other sessions coming up. So for our members, you'll obviously get communicated with that. Otherwise, you can go to our Smarter SMSF events page to find out more. And just a reminder, Tim and I do record each and every week our Feeling Smarter video. So if you haven't seen those before, take the opportunity to visit our YouTube channel. Also goes out in our monthly newsletter as well. Thank you to everyone that was on today, and to you, Tim. Obviously, it's was right in your wheelhouse when all this came about. So you've just totally engrossed yourself into this topic. So if you can't hang around, we will now answer these questions. I think some of these will probably form part of some upcoming Feeling Smarter sessions as well. But yeah, to everyone that's joined us today, a big thank you. Have a great rest of the day. Take care and bye for now.
Thanks all.